When it comes to home loans, there are many loan products available. It's good to know all your options before selecting the loan that's right for you. Your mortgage loan officer can help you make an informed decision as well. With a fixed-rate mortgage, the interest rate and your monthly payments stay the same for the life of the loan. The life of the loan, also called the loan term, is simply the number of years of the loan. A 30-year fixed-rate mortgage tends to be the most popular because it's predictable for the long term, which makes it easier to set a budget. You will also see fixed-rate mortgages with 15- and 20-year terms. The shorter the loan term, the higher your monthly payment will be, but you will also pay off the loan faster, which means you will save on interest over the life of the loan. Another option is a hybrid ARM, which features a fixed rate in the initial portion of the loan, followed by a rate that is subject to change at specified periods thereafter. For example, a 5-1 ARM means that for the first 5 years the rate won't change, but after that it can change once per year for the remainder of the loan term. So if your rate increases after the initial period, you need to be financially prepared to make those higher mortgage payments. ARMs typically adjust annually, and most have lifetime caps that establish a minimum and maximum interest rate over the entire life of the loan. Hybrid ARMs tend to offer a lower initial rate than a fixed-rate loan and can be a good option if you plan to sell or refinance your home before the introductory fixed-rate period ends. However, you should have a clear understanding of how much the rate could adjust after that time frame. When evaluating your loan options, you may want to see if you qualify for a government loan, such as a Federal Housing Administration loan, or FHA. An FHA loan allows a lower down payment and may offer more flexibility with your credit score than conventional loans. If you're a current or former member of the Armed Forces or the surviving spouse of one, you may qualify for a Department of Veterans Affairs, or VA, loan. If so, this loan does not require a down payment for certain loan amounts and may also offer a more competitive interest rate. Another option you have when it comes to your mortgage is buying points. When you buy a point, you are essentially paying a fee in exchange for a lower interest rate. 1 point is equal to 1% of your principal loan amount. The actual rate discount you'll receive depends on the loan term, the market, and your lender. Let's look at an example of a 30-year mortgage for $200,000. Each point would cost you $2,000, which is equal to 1% of the principal loan amount. Say in this example that the interest rate for your mortgage if you do not buy points is 3.5%, but if you choose to buy a point, the rate will be reduced to 3.25%. Your monthly mortgage payment with principal and interest would be $898 without points. If you bought a point, your payment each month would decrease to $870. This would save you more than $27 each month. To see if buying points is a smart financial decision, you need to figure out your break-even point, which is the time needed for you to recover the cost of buying the points. So in this case, it will take you 72 months or 6 years to break even. If you are planning to move or refinance again relatively soon and before the break-even point, buying points might not make sense. Keep these things in mind when considering what loan type is best for you. Think about how long you want your loan term to be, how long you plan on being in your home, and if buying points makes sense for you. To learn more about your mortgage options or the home loan process in general, check out our other videos, informative articles, and helpful tools.